Good evening, guys. Ken at Tortoise Capital, Nightly Strategy Podcast for November 3rd, 2022. So, this is a case study examining a standard pattern in the sniper methodology of finding critical states, compound critical states. I'm using this to explain to the folks at Edge Raider. It's a analytical firm in UK that's interested in using our methods for trading, for finding critical states in trading. They got an installed base of about 10,000 traders, and they've got a great tool set, but they need some help with finding, framing, and trading standard trades in this challenging market. So we're in contact. So this is how I explained to them today what we're looking at. So yesterday's report in the sniper set had this standard setup, the one-day movers, or the 1DM. And what that does is taking a look at the S&P 500 and examining the Z-score of the one-day percent move. So with that, how do we calculate that? Well, you look back over the last 30 days, and you find out the percent of the range for each day. And then you organize those into max, min, average, and then you find the standard deviation. And you know that normal would be average plus or minus 1 standard deviation. That's the range of normal. And then anything greater than a z-score of 1 means it's more than 1 standard deviation above the average. So that would be abnormal. So you find the z-score for all of the members of the S&P 500, and then you rank it by the z-score from descending order. So yesterday, Devon Energy was the 4th largest relative one-day move of any member of the S&P 500. It was a 4.77 standard deviation. And the 5-day z-score, calculated kind of the same way but looking at 5-day volatility, was also abnormal. So when you look at the sniper stats, you say, well, point number 1, the 150-day look back is at 0.63, so it's kind of in the middle of the long-term look back range. Nothing special there. The 30-day look back, it's right in the middle of that one. Nothing exceptional about that, except for the fact that it's like right on the 50-yard line. And if it's right on the 50-yard line, then we know that from there can actually be a large move in either direction before it breaks out of the 1.0 or the 0.0. So you can actually find sometimes nice moves. That's the idea behind the fence sitters. And then we notice that the 10-day look back, the tactical, was abnormally oversold short term at a 0.07. So what that means is that on the 10-day look back, that thing was sitting way down in the bottom 10% of its 10-day range. So there had been a harsh sell-off from the 10-day high for it to come in at a score of 0.07. Check or hold. Everybody see that? So you have an abnormal condition based on the 10-day. You could almost say it's abnormal because of the midterm right at 52. So if anything, this is a fence sitter that long term that has had a moment of rapid, significant oversold, and it has a abnormally high 5-day and 1-day volatility, especially the 1-day. When you see a 4.77, that's extraordinary. That's like 1 in a million almost. That's how extreme that is. So we now know that without even looking at the chart, that this thing will have fallen off a cliff yesterday And the fact that it was such an extreme range means it is already in play. It is emotionally sensitive in the people that owned it and now are suffering that loss. Well, we then can compute what the range stat is. That's the maximum reasonable intraday move, which is $4.46. So that's how far it can move and still be a normal move. And then if we take 1/10 of that as the start point, 1/10 of the range stat, to start estimating the minimum manageable risk box, we come up with about 45 cents. So I now take that number, 45 cents, and I just come over here and I say, look, that's about 50 cents. So that's going to be the size of the standard risk box for today. And this is where the market's going to open. So if I go back and look at the close of the previous day, and now I'm on 2-minute charts here, I can see that this thing was up around 70, and then in the last hour from 3 p.m. to the close, this thing just collapsed. It went from 70 all the way down to below 67 before it monkeyed around and finished up here. So that is a sign of extreme duress and fear and suffering. So that's how we can know that this thing is in play. And we've got all the conditions now that are ripe for a standard sniper move. So if we say something like this sell-off was probably fear-induced, that we wouldn't be surprised if it reversed and came back and tested that previous support level. So what did we get? It opened where it closed. It sold off and then resumed. We got a 1, 2, 3 entry. It broke above this congestion zone, and it moved more than one standard risk box off the low. It basically moved two. So we just took a routine 1, 2, 3 entry with our stop here. We started following up, and then when we see this extraordinary move up, we just say, whoa, let's get up there and lock that in, and then it gives a 1, 2, 3 exit. So we're able to capture, if that's 1R, we're able to capture 2R within about 10 minutes on what is essentially a reversal of this oversold emotional selling. That is just standard work. All it's doing is getting back to what the previous fair value was at some recognizable moment intraday. It just negated all of that painful selling. And then once people like us got their little fill and decided to cash because it didn't go further, you get a sharper reversal, and so you lock in your gains. If you don't take the gift when it's given, you're going to enter here, keep holding on, and now it's come right back to where you're at break even and you don't want to lose money, so you sell it, and then your bottom ticked. So learn to recognize a reasonable reward on your risk, which is 2R, and don't lose money on that trade and get paid. I took the exit before it entered the noise barrier of the dragon. The dragon is your friend. We gave it some room to work, about 5 minutes worth, and it didn't, so just take the 2R. So now we can say, is this thing done? No, probably not. There's the bottom of the dragon, and here's the next bottom of the dragon. So now we have a Kata 2 reentry, because now price has moved across the dragon. The dragon is rolling up. It has moved a MMRB off the PSAR. Here's a PSAR flip. You could have waited for that to enter, but when it moved one MMRB off this bottom, I just take one of the 2R, market's money, roll it in, and rebuy it. It starts moving up. Then I notice that by the time it makes the mechanical entry on the PSAR flip, I probably ought to just go ahead and lock in my little no-lose plus dinner for two. Now, I'm not going to lose any money on this trade. And then with just using a standard trail of a 1R, the stop looks something like this, and then right about here, I just lock in 3R and see, I wonder where you're going to go. And it kept going up. So there was more available. So this is nothing more than standard sniper work on a standard pattern in a critical state. This is how we find them. This is how we frame it. That's how we manage it. And that's how we re-enter. Standard work. Check or hold. Oh, well, here's the next one. So this is FI, and thanks to the alerts in TC2000, TC2000 found an extraordinary gap down. It closed here and then sold off something like $10 on 70, on 80. So that's like a 12% adverse gap. That's a large gap. It was the biggest gap in the S&P 500. It consolidated. So I waited for the 3-bar opening range to establish. Let's go see what that looks like, shall we? So it looks just kind of normal right here. This is where it gapped down to. It established the OR3. It rolled over immediately. At the break of the OR3 to the downside, I get short. I have a standard MMRB of 50 cents on this. And then in the next 15 minutes, all it does is give us 1, 2, 3, 4, 5. And then it rolls over, crosses the baby dragon, as my brother will tell you in the sniper course, that when this thing is failing, that's what it looks like. There's this little gap between the RL10 and the 3-period moving average of the RL10, or the baby dragon. And when this bottoms out and the next bar it crosses, that's an alert that this is probably done. So you might want to take that and then maybe hang an MMRB on that and say, somewhere around in here, I'm willing to give back that much and preserve 4. And so we exit at the standard exit at the PSAR, and then it immediately fails again. That's a COTA 2 to the downside. So we get short here, standard risk box, cash. It doesn't break out. It rolls over again, COTA 2, and now this time that thing pays off like a champ. All it does is make an orderly move down. Notice how there's that little leading edge there, the RL10 pulling the baby dragon down with it until it reverses. I take a 1, 2, 3, cash it. I'm not even interested in going long on this thing. It comes up, breaches the dragon for a moment, comes down, breaks through the PSAR. Guess what I'm going to do? I'm going to re-enter to the downside right where I exited 15 minutes earlier. Because why not? So all that thing does is just keep sliding downward. The PSAR is your friend. Violated, so I'm out here. So we get short here, exit there, and on a standard risk box, that's another couple R. And into the close of the day. So when all the smoke is settled, 4 trades, risking 50 cents, capturing this many dollars per share at 50 cents, a $3 capture on a 50-cent risk is 6R, and so this brings home 15. TC 2000 alert, largest adverse gap in the S&P 500 during a bear normal condition, down 12%. Do you think that's going to move the rest of the day? Yeah, probably. It opened around 68, and then closed around 57. So it started yesterday at 79 or 80, dropped to 68, so that's minus 12 bucks. And then from 68 it closed at 57. So that's another 11 bucks. So as large as the gap was, there was another $11 failure. There was, at a 50-cent risk, if you were perfect, there's a 22-hour trade just waiting to happen. So you might want to pay attention to the size of the adverse gaps and understand what the z-scores are and what the R10s are for everything in the S&P 500. Oh, you can get that in TC 2000. You can also get that from our daily report. I was monkeying around this morning and I got an alert on a large gap down in Weyerhaeuser, just an industrial transport company. It sold off. It gave me an R10 crossing the baby dragon. It gave me a PSAR flip. I was already fully committed on those other trades, but just for the heck of it, there's a standard risk box. There's your PSAR flip entry. If this gets you out, and it should, this should get you back in. There's your COTA 2 entry, standard entry. This one, the RL10 doesn't even get through the dragon, and it just gets tickled by the price, so that doesn't get you out. But if it does, this gets you back in. And then when it closes the gap to yesterday and peaks, notice that the run is done. All this move from here to here, all that did was recover all of the panic selling from yesterday and this morning. And then it just drifts into nothing. So Weyerhaeuser, with an alert on a SSC and a COTA 2, those are two very tradable moves inside a boring, dull industrial transport company, the S&P 500, that's not getting pushed around by news and momentum traders and all that other stuff. When I was talking with the Edge Raider guys and they were running their little tests on our filters, they said, hey, according to the way we looked at it, they like looking at the S&P 600, the small caps. They said, hey, we really liked Gilead. We like that pattern. Could you show us how that might work? So we pulled Gilead up and said, oh yeah, well here's where it opened, and that was the sell-off yesterday that made it a sniper target. And here was the gap up opening. Here's a COTA 2 entry. That's a standard risk box. That's a tradable move you won't lose money on. There's a COTA 2 entry you won't lose money on, and then there's another one. And if you use the PSAR flip, you get a very nice MMRB, even if you don't have the computation for the R10 MMRB, just by visual inspection you can see that that is enough room to give it, and if it violates there, you don't want to be long. So set that equal to 1 execution risk, and then just know your patterns. The trick is finding the things that are in critical states, compound critical states. And I suggested to them that I understood why they like the small caps, because they think those are really volatile and big movers. But I also said, look, small caps are not as liquid as the large caps and the ETF, so you don't always get a smooth and orderly move. But sometimes you do when it's in play. You can get a continuous price signal. But a lot of times you don't get that kind of steady price action that you get in the large caps and the ETFs. And so for that reason, I don't really look at the small caps. I would like to have a boring, dull, liquid, smooth mover, like, for instance, Frog Champion EWW Mexico. So why do I like Mexico as a trading vehicle, you might ask? Well, because it's a Frog Champion, meaning that it has nice, orderly moves intraday. It's very liquid. It's a country index, and that country of Mexico has a very diverse economy. It's the largest of the third world economies, so it's actually pretty large. and it's only marginally correlated to the US and Europe, so it does its own thing, and it has its own currency to push it around, and you have futures and options as well as the peso to trade. And so if you just take a look at the last 5 days in these blue boxes, you can see that in every one of these blue dots is where a typical sniper entry pattern is signaled because of a PSAR flip. And then right after that move, you get a very orderly tradable move. And this is what I like about Mexico. Very orderly, continuous signaling. And you also get significant volatility on moves intraday, and you get moves in both directions. Now, this is what happened on the Fed day. And so remember, the Fed is a dangerous opportunity. It is no place for a nervous person. So yesterday, EWW was on our list of sniper targets. Why? Well, because that harsh sell-off made it at an extreme oversold, and then it gapped down and gave you a COTA 2 and an SSE entry, and you got a couple moves intraday where it's just trying to recover the pain and suffering from the previous day. So target selection matters a lot. You want it to have the characteristics of the kinds of trading instruments that you want. EWW does that for me. So these blue dots are places where we get typical entries, and you can see that pretty quickly we can get our risk to no lose plus dinner for two, and then we can turn it into a disinterested science project to see what we can harvest. To the charts. 30-day look back over the last 10 days. So we're looking at a tactical array here of SPY. Here's your 5-day, your 10-day range. There's your 10-day high. There's your 10-day low. This was the big sell-off during the Fed day yesterday that looked like this. That was the Fed day. And today there was a gap down and then a kind of an orderly recovery. The most important thing was that it did not fail further. Did not fail further. And it's testing the 30-minute PSAR that's coming down. So it would not be surprising to see a tactical move tomorrow that gets half of this move back. So 378 is in play. 384 is in play just to get back to the previous fair value prior to the Fed shenanigans. So that could very easily happen. It could also happen that this thing fails, tests yesterday's low, and if that fails, comes down and tests the 10-day low, and if that fails, you want to be short in a large way. So I could actually see an intraday strategy tomorrow that looks like short one position, short two positions, and ready to go short three positions if those support levels are breached. By the same token, to the upside, a breakout above the PSAR is a tentative long. And now this is not resistance. This was just panic selling. So you don't even get resistance to 382. You could easily see tomorrow some tactical recovery up to 378, 382 in that region. So 2 legs up for a very small unit of risk. So tomorrow is going to be a tactical trader's delight, trying to see what people are going to hold on to going into a weekend in which there was a lot of concern about what the Fed said. So tomorrow is going to be a volatile day, which is what a trader wants. So here's what it looks like on the daily chart looking back 30 days. There's your 1-day range, your 5-day look back, the 5-day high and low, the 10-day look back, 10-day high, 10-day low, 20 days, 30 days, 30-day low down here, 30-day high right there. So we're only halfway down to the 30-day low, which was way back there around 350. So that's why I would say if tomorrow breaks this support level, look out below, and then if the 10-day low breaks, look out below to the collapsing dragon. If that breaks, you can see how this can get back to 350 in a hurry. as we approach election shenanigans. But to the upside, that could be a recovery for that harsh sell-off of the Fed. That's still baked into the cake, and there may be some people think that's an overreaction and are aiming for gains in that tactical area. It's not a good thing until it gets above 390 and clears that previous peak. On the long term, you can see that we're still locked into this to this bear normal. We still are suffering with the one, two legs down. Couldn't really break out. This one got you two legs up, but then harshly sold off. So we're still stuck way back here in this cluster, hoping that it's bottoming action and we can see that. That'll get this back to 430. But again, until it gets above 390, that previous peak, this is just tactical noise and ideally suited for intraday trading and no overnight risk. And the downside trade is the easier one to believe in because we're in bearish normal. All right, let's look at the sectors. Oops, a little too big there. There we go. 1, 2, 3, and so here's the S&P today, minus 1%. The Qs, our tech leaders, were worse at minus 2%. The Russell was less bad at down 0.67, Treasuries off 0.5, Diamonds off 0.46, and then here was the cut line, right by cut. The difference between gains and losses for sure for today. Emerging markets were the only big index in the green at 0.58. So still mostly gloom and despair in the U.S. as we try to sort out what's happening in the Senate and all that stuff. Right. All right. Let's look at the underperformers first. Again, the S&P is our baseline, 1.03. So you got oil, ARC Genomics, and the Aussie dollar down to minus 1.18. You have the FANGs, the VIX, wheat and precious down to 2.14. You have S&P Tech was the worst sector of the day at minus 3%. And now individual targets. Coinbase, Apple, and PayPal. Coinbase minus 8, PayPal minus 3.6, Apple another 4% loss. Microsoft getting smoked for 2.66. That's where that pain and suffering in XLK is coming from. Squarespace 1.34, Texas Instruments 1.25. Cliff and U.S. Steel 2.2 and 3%. So let's take a quick look at our metals since we see them all on the screen. So the metals as a group, Cliff was terrible at 3%. U.S. Steel, terrible at 2.2. Alcoa was the least worst, only down 0.19. So if you were a betting man and you saw strength in the metals and Alcoa was the best, that's the easiest one to believe in because it resisted the sell-off of the market. People were actually buying Alcoa because it's only down 0.19, whereas the market was down 1%. So on a relative strength basis, Alcoa actually showed some hidden strength. Check or hold. All right, let's look at the upsides. Here's the S&P, minus 1% again. Here's the cut line between winners, absolute winners, and absolute losers for the day. So to the upside, what was better than the S&P? Well, you had finance, biotech, ARC Innovation, consumer discretionary, agriculture, and staples, only down 0.13. So you had some strength in that little cluster. The next cluster, you had blended commodities, real estate, lumber, Bitcoin, and uranium. I'll throw Tesla in there. So now you're at from between minus 0.2 and plus 0.36. Now you start seeing some real strength in materials, 0.76, commercial real estate, 0.87, the other lumber, 1%, Ethereum 1%, lithium 1.2, Mexico 1.2, clean energy 1.46. So some real winners in that little cluster of commodity based and energy based. Then the big winning sectors for the day: oil exploration 2.28, Brazil and Mexico marijuana, I should say, 2.74 and 3.9. And now individual companies that did very well: Robinhood. Now here's an interesting divergence in the financial services. Robinhood is up 8%, Coinbase was down 8%. So it was not a sector response, it was really individual company based. Devon Energy 4.8, Rivian 2.28, and now we'll take a look at Nvidia 1.5 and Intel 0.11. So we saw that the metals generally underperformed today. So energy with our little buddy Devon was great. I'm looking for that one tomorrow to continue to move. And then our semiconductor group, little mini group, Nvidia was best at 1.53, Intel in the middle at minus 0.11, and then Texas Instruments by far the worst, minus 1.25. So all other things being equal, you got to like Nvidia, Devon Energy, and Alcoa for our individual preferred companies for tomorrow. All right, let's take a look at the individual. Oh, look at the individual traders first. We only had a couple posted. So we'll get those knocked out real quick. Luke, back into good form here with the 5-minute Aussie. There is his SSC. It went spring, winter, spring, winter, then the PSAR flip, standard risk, 1, 2, possible second entry, but he takes the exit near the indicated point for about 1.5. Yep, 1.5. He goes for the collapsing dragon short, doesn't work, so stop and reverse for a scratch, and then re-enters short, and then makes another 2.2 for a total of 3.2 for the day. Nice work. Les with the Kiwi. And in his fashion, he plays his cards pretty close to the vest. It doesn't really break out above the VWAP, so he doesn't give it room, and he takes a snack at 0.7. And then when it fails through the PSAR, he can ride that a little longer for 0.7. Here was the PSAR flip. He waits for it to get through the VWAP, which I like. He takes his snack right there for 0.5 to come in at 1.2. If he's not away from the desk, I'm going to coach him to say, look, this little congestion zone, it never came back and tested. In fact, it started to break out, so that would be your indication that the next leg up is working. And you would get that next leg, and then he would probably exit somewhere around in here. So there was probably another 2 to 3 are available in that opportunity. So that was the traders' reports from today. Good job by the fellas. We're going to look at the reports now. Take a look at tomorrow, and then I got a master class here for Luis, if you can stick around, Luis, on position sizing to answer your questions from earlier. Let's see. Home. Page. So we're going to zoom down to dashboard number 1. And just a reminder, bearish normal, the most important factor. Oversold conditions on the 2 and very close to oversold on the 10. The risk Z is starting to roll over, so that's showing potential for large moves in either direction. The winning positions are the industrials and the staples like Caterpillar, McDonald's, the energies of ExxonMobil and Chevron. The max pains are the ones that are getting punished now: Microsoft, Alcoa, Tesla, Disney. Keep riding those things down when they fail. Make them prove that the conditions have changed. Lots of activity here in the Dow because now the sell-off is getting a little dicey. You got a lot of auto framers, lots of 5-day down patterns, breakdown in Microsoft on the 10-day through 6-month breakdowns, a little breakdown in Apple, but the one in Microsoft is significant, and that's 4.7 to 1, and it's a 5-day down. That is a screaming frame for a tactical trade tomorrow. Be ready in Microsoft. In the ETFs, we had a few breakdowns. Here's consumer discretionary, S&P Tech, NASDAQ Tech. That's problematic. There's a plentitude of auto framers. Brazil and Mexico are the hidden gems right now. They've weathered the storm on the election, and they remain volatile enough to trade, and they are diverging from the U.S. What's not to love? Plenty of auto framers to choose from. I leave it to you. Note the 8 to 1 on Cliff. Holy smokes. 4.7 on Microsoft, 4.5 on U.S. Steel. If you needed an invitation to be ready, there it is right there. Holy smokes. And the whole tech sector suffering. That's as clear as day. You got to be able to see those divergences. There was some range compressions today, believe it or not, after the gap, and that's what this measures. So the S&P, Tech, Alcoa, Cliff, boy, is that ready-made for an explosive move, and using the full daily range as your risk. If you wanted to use like hourly charts, you could do that and never take more than a 1-hour loss, but have a potential for a really nice range expansion tomorrow. Godzilla's in the sniper set. Oh, there's FIS again. All of these that are, multiple greens. And look at 4 and 5 sigma 1-day moves. Holy mackerel, are those in play? And Microsoft, a Godzilla in our tactical set. If you needed more invitation, there it is. Newmont Mining and Amazon and Microsoft are in the Godzillas. Gotta love it. Here's that. I will be on this one tomorrow, FIS, with a 10 sigma move. Must pay attention. The 1-day movers is where I found the movers this morning, and setting up FIS. That was the alert on the gap, and then it just followed through with a huge move. But Kellogg's, let's see if there's anything else in there we notice. That's enough right in there. Even some of the super quiet ones on the 5-day are starting to trigger on the 1 day. So APTV with a 2.5 sigma move today, that's worth noticing. So you're looking for divergences on both of these, as well as magnitude. You're also looking for divergences like this. Target rich environment. Tail of the tape, the haves and the have nots. You can see who's benefiting from this climate of chaos. All the old reliables and energy, Mexico. And who's getting smoked? Tech, blockchain, Apple, PayPal, Microsoft, the metals. There you are. Find the divergences and the big themes. Look at the extremes for big movers. Now, after the gap and the marginal sell off the rest of the day, I just want you to notice that is a perfect critical state right there. Because you had a nice long grinding run, 2 days of harsh selling after the Fed, and then a little gap, but it stabilizes. That's a perfect critical state. Tomorrow's going to be fireworks. Lots of posturing. But I predict there's not going to be a lot of interest in holding moves overnight. So tomorrow, especially, a bird in the hand is worth two in the bush. All right, that's everything from the report. I'm going to cover some money management stuff for Luis next if you want to stick around for that. Let's see, where am I? Luis is in the coaching program, so he gets to ask me good questions. So the first question has to do with let me get the drawing. All right, when executing a trade, when you have two position sizing units available. So just as a refresher, I have 4 units of risk available. So I call them bullets because from my training as an infantryman, and you got to preserve your ammunition when you're a ranger because you are disconnected from the supply base. So every bullet counts. Plus, when I was a kid, my dad would give me a 22 rifle and 3 bullets and say, go out and get a couple rabbits for the cook pot and then to sell the fur. And that's what we could use to buy more ammo. So make every shot count. So respect the risk capital. And so these are all standard units of risk of dollars for me. So standard dollars. Okay? And so my span of control means how many open positions can I manage at one time before my performance curve goes down. Okay? And Gary notes, that Tharp's definitive guide to position size and great resource. Yes, I think for systems and large numbers, but the position sizing insight I'm going to give you here is for tactical psychological self-management that is tuned to my psychology and which is teachable. So it goes into some other areas that Van's stuff doesn't go into. This is more at the operational and tactical end. So I can manage up to 4 before my performance curve starts to really diminish. If I put 5 separate positions on or have 5 units of risk, I start to get distracted and can talk myself into not looking at one that's underperforming if I have another one that's working. So 4 is what I can manage and make effective rapid decisions, 4 moving pieces. So what I'll do is I'll start the day with 4 units of risk on available. And then let's say the first trade fires. I put my little risk box in there and it takes off and off it goes. Now I've committed 1 bullet to that position and I have 3 available. So maybe later in time, another thing is it fires, and so I put a second position on. So now I've got 2 bullets accounted for. And then now maybe this thing has a pause and then continues. And I say, oh, well, there's a COT of 2. And what I'm going to decide to do is I have no other better ideas, and that's tradable. And I've locked in my risk. My risk is probably up in here now. So this one is safe. I can now commit. Now I've got 2 units of risk, and I could either take a third position, or I could take that bullet and put it as a second position on the existing trade. I always prefer to do that because now I just have to watch one chart for managing those 2 units of risk, and then I can fine tune my exit because I got a double scoop on. So if I have 2 position sizing units available, I can either add a second position on one that's working, or I can open a third position. And equally valid, as long as they are positive expectancy trades and I'm not taking shortcuts, all of that is okay. Now, something that happens, let's say I do this and I have an entry and it works. So I've used that risk. And then maybe that thing rolls over and it hits my exit. Well, I will have made this amount of money right here. So what I'll do is I'll take the money that was at the risk, put that and reconstitute my bullet, and then take the money and put that in the bank to pay forward to tomorrow. I'd like to be able to start paying for tomorrow's bullets with profits that I made today. After I've made 4 net profit, then I can start thinking about adding even more positions than just 4 because I have some markets money to play with. So what I'm doing all the time is rotating money into positions, harvesting the gains, reconstituting my ammo, paying it forward, and then only then am I looking at having more units for intraday piling on. Now, when not to enter the trade if I don't have 2. I'm not sure what you mean by that. I think you might have been asking, hey, if I don't have 2 to 1, do I enter a trade? No. Can I enter a trade if I only have 1 unit of risk left and I don't have a second bullet to put in? Yeah, you're just going to trade it with 1 unit of risk because you probably already have 4 units of risk on. What if I had enough losses that, I put this trade on with a standard risk and this thing failed and I lose a full -1R? Well, what that means is I only got 3 units of risk left for the day. And then those 3 got to work hard, not only to now if the next position wins, and maybe I make 2R on that one, the 2R gains got to come in and reconstitute the bullet. Now I can get my 4th bullet back, and then I can pay forward. So what I'm always trying to do is never have more than 4 units of risk on, and I would like to have 2 units in one trade, 1 unit in another one, and then 1 ready to reinforce, either to add to this one or make this one 3. If I ever get 3 positions on, I'm typically going to just cash the other one or put a trailing stop on it so I won't let that distract me, because if I got 3 positions on, I really got to act intelligently and focused, no slack. How does this interact during sniper trading? Exactly the same way. The sniper simply finds targets that are more likely to make large moves out of a compound critical state than others. And then the patterns that the sniper is taking is simply like a Z3P or a supported spring crossing or a COTA 2. These 2 are like PSAR flips, and you've seen me do that endlessly. And the sniper is just the combination of selecting the target, choosing the pattern, and then ruthlessly interacting. Now, one of the things that my brother does with his units of risk, he has been experimenting and I think perfected the 2R battle drill as a way to enter new positions automatically. So when he gets a signal to enter his sniper pattern, he automatically counts up 2 units of execution risk, so execution gain, and then he puts a price level that if price gets through there, he's automatically putting on a second position. So the first bullet went here, and he puts a second bullet on at 2R, and then tightens his stop, and at another 2R, he adds a third one. So he has a way of like automatically feeding those things in just on the basis of locking in 2R at a time, and then that takes away all his cognitive load of discretionary thinking, and his job is just to get these positions to no lose as soon as he can, so that when he's out all 3 positions or 2 positions, whatever, however many he has, and then can reconstitute the stack of his ammo. So he minimizes the number of different symbols that he's trading, and he's trying to find the mover and get those positions built up rapidly with market's money, locking in and controlling his risk, and then exiting everything when the signal is over. When the run is done, it's done. You can't persuade it. Now the second position is, or the last question, I should say, is a really important question because it has to do with system design and annual returns. And I'm going to make a couple points on this before I get into the math. How to correctly position size if your goal is 100% returns a year. And this is where I disagree with Van about establishing targets and goals. I'm going to follow the advice of Scott Adams, the cartoonist and hypnotist who does Dilbert. And what he says is, and I agree, is that you want systems that perform. You have some input and then a process that is carefully managed and an output, and then your output goes onto a pallet, and then you start stacking up your results, and then you concentrate on good systemic process, and you let the goal take care of itself. If you have a good risk managed process with lots of opportunities and you're generating R, it is far better to take a look at what you can reasonably achieve and then use that to estimate the number of trades that you're going to get and how much money you can afford to manage in order to get to 100%. Because also it's the size of the capital that you have at the start. To get 100% return on 100K in an account is a lot different than 10K, which is a lot different than $1 million because of the size of the positions you got to take and the size that you can be in a particular target. So I'm going to advise you, don't focus on 100% per year, but instead concentrate on perfecting your process and your system. And then what I suggest you do is start with $1 at risk or 1 share, and then execute perfectly until you have absolute confidence in the pattern. And if it's positive, now discount the cost of commissions because that's going to be large relative to the amount of money. So don't let commission rates distort the R capture of what you're getting. So you get an entry here and then you exit there. You're looking to see what was the R capture. Don't worry about the admin charge yet until you get up into production. Once you understand the R capture and you have a positive expectancy system with $1, now risk $10 per trade as the unit of risk, the dollars at risk. And then when you're positive there, go to 25, and then 50, and then 100. And how much money can you add to the standard unit of risk and still execute perfectly? Is there some number up here that causes you to pay more attention to the dollars and second guess your system? If you've invested in perfecting your process all along the way, then you should be able to scale like this using markets money and continue to perform the trades in exactly the same way. Once you get up to a couple hundred trades or 500 trades and you have some reliable data, then and only then should you be looking at what does it mean to get to production and what can I achieve. By that time, you'll know the number of trades per day and the number of trades per week and then what your performance stats are, and then you can use that to estimate not 100% return on the year, but I'd say how much money do you want to make, and now you can turn that back into a math problem to come up with statistics, use the statistics to determine what is the size of the risk per trade that you have to get to at that frequency of opportunity to make the money that you want to achieve. Now, that's the bottoms-up approach, and I'm going to tell you, concentrate on that, because unless you can do that, then all of the math that I'm about to do doesn't mean anything, but it puts extra pressure on you. Now, I'm going to use an example of a soccer team. Let's say in the soccer match, I have a goal of saying, I want to score 2 goals per game. I think if we can score 2 goals per game, then we're going to win. And I look at the other goalie, and I see that guy has a 90% win rate, or a save rate. He saves 90% of the shots. That means I'm only going to score 1 out of 10 times. So if I want to achieve 2 goals, I'm going to have to figure out how to take 20 shots a game. Well, what if it happens that as we start playing and we're 30 minutes into the first half and we don't have any shots on goal yet because we haven't been able to tactically get it? Now suddenly, in order to get, if I set a goal of 20 shots, now I've only got 60 minutes to get 20 shots, and now I may end up changing the way I play because I think I got to take 20 shots. But I held them without scoring for 30 minutes, and now suddenly I'm going to take extra risks to take shots just because mathematically I'm trying to get 2 goals. Why would I do that? I don't want to do that. My first rule is defense. Don't lose money. Don't get scored on. Play well in my process, and then take my chances when I get them, and then we'll just see how many goals we score. So that's a different strategy than being focused on, goals per game or percent return a year. But let's just suppose that now that I've understood my target or my trading, and I've looked at tens of thousands of trades that I've performed over the last 30 to 40 years, and I can say something like, what I need is 2 position sizing risks per week is my system goal. If I can net 2, then I can net 100 R in 50 weeks. And now if I'm trying to make 100 grand and I'm going to make 100 R, then that means that my position size, my risk per trade is going to be something like $1,000 in order to get a weekly R. So if I've got 20 trades a week and my win rate is 60%, I'm going to say 50%, and 25% are scratch, and 25% are losses, and my average win is 0.6, and my average loss is 0.3, and the scratch pays for itself. Well, if I do the math on that, 10 trades at 0.6 is 6R, and 5 trades at minus 0.5 is minus 1.5. So if I have those numbers, if I can produce those numbers reliably week after week after week, I have a reasonable expectation of making 4.5 a week on average, and I only need to net 2 a week. I've given myself plenty of wiggle room that at $1,000 of weekly R that I can net 100. I have to make $1,000 a week. So I have something like a target of I'd like to make 200 a day, and my standard unit of risk right now is $400. So if I can net a half an R a day, I can get my weekly goal of $1,000, and my daily goal of 200, and I'm averaging 400. I'll be able to make the money that I need all the way through. So all of this is based on what the numbers actually support from your performance, rather than taking a top-down view that says, well, I have to make 100%, so I must invest 2%, and you have no idea if you can trade at that level to make your 100%. And what number did you use to start with the capitalization? 100K. Why that number? Start with the dollars that you need to achieve per year out of that system, and then work backwards into actual performance numbers, and then you can have a realistic production schedule on what your system will do. If you're not getting enough opportunities, then you got to look to find ways to either automate or expand your opportunities or change your time frame, increase your span of control, or hire an assistant. All of those things are much better use of your time as you're trying to establish what your system will achieve, in my opinion. I think you should be focusing on improving your system, stop the leaks, stop leaking, remove pressure, establish routines, increase frequency and number of opportunities that are traded in a standard way, and look to achieve standard work so that you can establish a little black box of a little factory that is producing R. Standard inputs, standard trading, standard production. Turn that into a histogram, and now you have a manufacturing table that allows you to determine what can I reasonably achieve per week. If you discover after doing that you need to be trading at $500 of risk per trade for position sizing, and if you set your execution risk at 0.2, you may discover you only need to be risking $100 a trade, but position sizing at $500 a trade, because you are not taking large position sizing losses. That's where this math leads you to. Now, over the last 15 years of live trading weeks where we were just going maximum performance on camera, we were getting something like 100 trades a week and producing about a 60% win rate, about a 20% scratch, and about a 20% loss rate, and the average win was 2-to-1 minimum, using 3, 5, and 10-minute trades. And you've seen some of the numbers that we've been cranking over the last 6 months with the sniper. You've seen days when there were 20 execution risks. And if you set that equal to 0.2 of a position sizing risk, that means that 20R day was really a 4R position sizing, and you get that in one day when you only need to net 2R a week to make your 100R. So that should tell you how important it is to safe side and lowball your performance numbers so that you don't have to be perfect. You only have to be average on this, and you can even afford below average performance and still make your weekly goals. That is a much more realistic and less stressful event. Now compare that to a retail trader who's trying to pick the right winning trade and execute it perfectly with lots of leverage, and look at the stress level on that guy's performance. That's where the fear and greed and the emotions come from, and that's why we look for the abnormal price movements that show when people's fear and greed is collapsing. If you're going to be professional about this, in my view, and in our approach, that's the mentality that you want to take. You want to be an industrial machine making bricks. So you got to gather raw material, make a lot of bricks, stack them on a pallet, move it to the work site, build a wall correctly, and build a structure that will withstand the pressures of nature and time. We are in the business of making bricks, one brick at a time, one trade at a time, standard work every time. That's the message that you will continue to hear from me. Hopefully, I've answered your question. And and for me, the span of control at 4, it took me time to do that. I had to start with 1, then 2, then 3, then 4, and it took me time to be able to execute 4 units of risk perfectly enough to be professional. And that's why I make the emphasis: learn to trade one trade at a time with perfect execution at your standard work rate. Go slow and smooth. The speed will come later and the span of control will come later, but only if you have built the muscle memory that it takes to execute correctly. All right, that's everything I wanted to say about that one. So think about that and then send me any follow-up questions if you have. That's everything I got for tonight. And take good care, and we shall see you ready to rock tomorrow. Hey, that's top shelf stuff right there, guys. That's an entire workshop